All right, everybody, welcome back. You ready to jump into another deep dive with us? This week, we're going to be tackling market trends.
It's been a crazy ride so far this year, hasn't it?
Yeah, I mean, looking back, 2024 was really something else, especially for the U.S. market. A lot of folks are probably wondering where we go from here.
Definitely. I mean, 2 years in a row with the S&P 500 gaining over 20%. We haven't seen that in a quarter of a century.
Exactly. It's got to be on everyone's mind, right? Is the bull market still charging ahead? Or are we headed for a correction? I mean, you got to factor in inflation and interest rates and all that fun stuff, too.
Well, we've got some great analysis to dig into today, and I think you'll find some of their insights pretty interesting, surprising even.
All right, well, let's get into it. Starting with this week in the U.S., the Dow dipped a bit, but the Nasdaq and smaller cap stocks actually climbed. So what gives?
You know, this is pretty typical for the end of the year. It's likely just some profit-taking happening. After such a strong run, a lot of traders cash out before the holidays kick in.
So just a little breather before the next big move.
Could be. But we can't ignore the bigger picture. Inflation and rising interest rates are creating some real headwinds.
Okay, so let's talk about those headwinds. The Chicago PMI just took a nosedive. 13 months of contraction, the sharpest drop since May. Should we be worried?
Well, the PMI is basically a gauge of how manufacturers are feeling about the economy. When it's below 50, that means they're feeling pessimistic, and this latest reading is well below 50.
Yikes. So not exactly a glowing endorsement for the economy right now, but on the flip side, jobless claims are at an 8-month low. People are still getting hired, so that's got to be a good sign, right?
Yeah, the job market is a key indicator. But keep in mind, it's a lagging indicator, so what we're seeing now might just be a carryover from earlier in the year. We need to watch it closely to see if it continues.
Got it. All right, so zooming out to the global scene now. Europe saw a slight uptick this week, but the UK is actually doing a bit better, getting a boost from the weaker pound, which helps their exports.
Yeah, a weaker currency makes exports more competitive on the global market. It's like a built-in discount for international buyers.
Interesting. So currencies can play a big role in a country's economic performance, but then you've got China down significantly, and Japan, even though they had a good year overall, ended on a low note. What's driving those differences?
China's been dealing with some weak manufacturing data, and their property market is still struggling. Those are major drags on their economy. Japan, on the other hand, benefited from a weaker yen earlier in the year, just like the UK. But that advantage is starting to fade.
Sounds like the global markets are constantly in flux. It's like trying to solve a puzzle that keeps changing its pieces. Now, before we move on, I wanted to touch on two specific cases, Turkey and Mexico. They both have some interesting developments.
Yeah, these two really showcase how different economic policies can play out in real time.
Right. So let's start with Turkey. They actually did something that investors applauded, which doesn't happen every day.
For sure. They went ahead with a minimum wage increase, but it was smaller than everyone expected. And then, get this, they surprise everyone with an interest rate cut.
Wait a minute, a rate cut. Isn't that usually done to stimulate a sluggish economy?
Exactly. It could mean they're shifting back to more conventional economic policies after a period of some, let's say, unconventional moves, and investors seem to like the change.
So maybe a ray of hope for Turkish markets. Now, what about Mexico? They cut rates too, but their message wasn't as clear.
It was a bit mixed. They acknowledged that inflation might be easing, but they also pushed back their target for reaching 3% inflation by a whole year.
Yeah.
They're playing it safe, which might be smart, but it's left some investors a little confused.
So a lot of moving pieces and a lot of uncertainty still. It looks like we're at a crossroads. 2024 was amazing for stocks, but can it keep going? That's the big question hanging over everything we talked about today.
It is.
We saw some positive momentum carrying over from 2024, but there are definitely some warning signs popping up too.
Yeah, no doubt about it. And I'm sure it's leaving a lot of investors scratching their heads, wondering what to do next.
Right. So how do we cut through all the noise and figure out what really matters? What should investors be paying attention to right now?
Well, I think understanding a relationship between interest rates and inflation is absolutely crucial. Remember, the Fed spent all of 2024 hiking rates trying to get inflation under control.
And those rate hikes had a big impact across the whole economy, right? Businesses had to deal with higher borrowing costs, mortgages got more expensive, and consumers started feeling the pinch.
Absolutely. Higher rates are meant to slow down spending and cool the economy down, which, in theory, should bring inflation down.
But it's a delicate balancing act.
It is, because if the Fed goes too far, if they raise rates too aggressively, it could trigger a recession.
Yeah, that's the big fear hanging over the markets right now. Is the Fed going to over-tighten and push us into a downturn?
It's a tough call for them to make. And what are the folks at T. Rowe Price saying about this? What's their take on the whole interest rate situation?
Well, they're urging caution. They point out that inflation is still pretty high, despite the Fed's efforts. And they're worried that more rate hikes could really hurt the economy. So it sounds like inflation is still public enemy number one. What can regular investors like me do about all of this? Should we be running for the hills? Or are there still some good opportunities out there?
Well, uncertainty always makes people nervous, but it can also create some really interesting opportunities.
Hmm.
The thing is, markets tend to overreact to news, both good and bad. So when everyone is freaking out, that's often a good time to buy quality assets at a discount.
Interesting. So don't panic, do your research, and try to find those hidden gems.
Exactly. And this is where diversification becomes so important. Don't put all your eggs in one basket, as they say. Spread your risk across different asset classes.
Right.
Stocks, bonds, maybe even some alternative investments.
Right, a balanced portfolio. That's what they
Yeah.
always tell us. Now, we've talked a lot about the U.S. market, but what about the global landscape?
Mm.
What are some key developments that investors should be watching on the international front?
Well, we mentioned earlier how China's economy is slowing down, and that's a big deal. They're a major player in the global economy. If they stumble, everyone feels it.
Especially with so many businesses relying on China for manufacturing,
Mhm.
right? And as a key market for their products.
Absolutely. A slowdown in China could disrupt supply chains and hurt corporate earnings around the world. And then you've got the war in Ukraine, which is still causing chaos in the energy markets and creating a lot of geopolitical instability.
Yeah, that adds a whole other layer of complexity to the mix.
It definitely does. It seems like we're living in a time of constant upheaval and uncertainty. It makes it more important than ever to stay informed, be flexible, and be ready to adapt your investment strategy as needed.
So the set it and forget it approach to investing is out the window.
Pretty much. You really need to be an active participant in shaping your financial future.
All right, so we've covered a lot of ground here. We looked at current market trends, the broader economic picture, and some strategies for navigating all this uncertainty. What are some key takeaways you want listeners to walk away with today?
I'd say the most important thing is to not panic. Volatility is just a normal part of the market cycle. Focus on the long term. Don't let those short-term swings throw you off course. And stay informed. The more you understand about the markets and the economy, the better decisions you'll be able to make.
Great advice. But before we wrap up, I want to throw a question out to our listeners. We've been focusing on interest rates and inflation, but what about other potential risks? What are some of the wild cards that could shake things up in 2025 and beyond? Those unpredictable things that could really throw the markets for a loop in 2025.
Yeah, the things that keep investors up at night, trying to figure out what might be coming next.
Exactly. So what's on your radar? What are some of the potential curveballs we should be thinking about?
Well, we've already talked about the geopolitical risks with the situation in Ukraine, but that's just one piece of the puzzle, right? I mean, there are other potential hotspots around the world that could flare up pretty quickly, like the tensions in the South China Sea, for example, or political instability in different regions. Those kinds of things could definitely impact global markets.
It's kind of like trying to predict the weather. You can see the big storm clouds gathering, but there's always a chance a sudden squall could pop up out of nowhere.
That's a great analogy.
Yeah.
Yeah, and just like with weather forecasting, the further out you try to predict, the less accurate you're going to be.
Right. Okay, so even if we can't know exactly what's going to happen, we can at least try to be prepared for different scenarios. So besides those geopolitical risks, what other wild cards are you keeping an eye on?
One that doesn't always get enough attention is the potential for technological disruption. Think about how fast technology has been changing lately. Artificial intelligence, automation, blockchain, all that stuff.
It's mind-blowing.
Right. And these innovations, they can completely reshape entire industries, which means there will be winners and losers.
For sure. The pace of change is incredible. It can be hard to keep up, even for experienced investors.
Definitely. What's cutting edge today could be outdated tomorrow.
Yeah.
So it's super important to stay informed and try to really grasp those long-term implications of, new technologies.
So keep an eye on the innovators, the disruptors, the companies that are willing to take risks and challenge the status quo.
Absolutely. Those are the ones that could really pay off big time down the road. But remember, always do your research. Don't just assume that because a company is working on some cool new tech that it's automatically a good investment.
Right. You got to understand the business model, their competition, their growth potential,
Yeah.
all that good stuff.
Yeah, exactly.
Okay, wow. We've covered a ton of ground today. Market trends, economic indicators, potential risks, opportunities. It's a lot. What's the one big message you want our listeners to take away from all of this?
I think the main takeaway is that, well, the future is always uncertain. That's just the nature of things. But that doesn't mean we just sit back and do nothing, right? By staying informed, staying engaged, and taking a long-term view, we can navigate these choppy waters and set ourselves up for success.
Love it. And remember, everyone, knowledge is power. The more you know about what's driving the markets, the better decisions you're going to make. And that's how you reach your financial goals.
Right, and don't ever lose that sense of curiosity. Keep asking questions, keep exploring, keep learning. That's how you stay ahead of the curve.